Welcome to our second quarter video update for the year 2023. As you can likely see, Maria Dawes is taking a well-deserved time off, and so I would like to welcome back Paul Carter, Senior Portfolio Manager at Capstone Asset Management.
Good morning.
Paul, we have a lot of ground to cover as per usual, so we'll get right into it. And because this is a quarterly review, could we get your take on what's happened in both the bond and stock markets during the past quarter?
Sure. Well, since we're in the midst of the most aggressive cycle of interest rate hikes in decades to combat the worst inflation we've experienced in decades, I'll start there. In May, the U.S. Federal Reserve decided to raise the target rate target range for the federal funds rate by 25 basis points to 5 to 5.25%. But then in June, it paused for the first time since it began a string of 10 straight rate hikes. While some investors got excited about this, the Fed made it very clear that they are not done. In fact, as of this morning, the futures market is suggesting there's about a 95% chance that the Fed increases rates again on July 26th, and about a 20% chance that the Fed does so once more by the beginning of November. And that's despite the fact that yesterday, the US Labor Department published a surprisingly low consumer price index report. Now, here in Canada, while we haven't moved in perfect lockstep with the Fed, the Bank of Canada also increased its target for the overnight rate by another 25 basis points in early June. Now, as a result, interest rates across the yield curve increased in the second quarter. While this makes for higher bond returns in the future, this impacted the value of existing bonds this quarter. As a result, the Canadian bond universe had a total return of about negative 0.7%, reversing some of the gains in the first quarter when bonds were up about 3%. Now, what's bad for bonds is often good for stocks, and that was kind of the case this quarter. The reason interest rates keep climbing is because inflation isn't coming down as quickly as central banks would like, or as quickly as central banks were expecting earlier this year. And the big reason for that is that consumer demand in both Canada and the US has been surprisingly strong, even as mortgage rates and interest rates on credit cards and auto loans continue to climb. So even though companies are dealing with wage inflation and an increase in the other costs of producing their goods and services, higher customer demand has resulted in revenue and earnings expectations to hang in there. In the US, as an example, earnings expectations for publicly traded companies fell throughout 2022 and the first few months of 2023. But since the end of March, these expectations have stopped going down. While many investors were worried earlier this year that interest rate increases would push us into a recession, some are now coming to the conclusion that we could be headed towards a soft landing where inflation gets back down to 2%, interest rate increases stop, and we avoid a contraction in GDP. As a result, global stocks, as defined by the MSCI World Index, was up almost 5% in Canadian dollar terms this quarter. The biggest driver of the global stock market, though, was the technology-heavy US market, where the S&P 500 index returned 6% in Canadian dollar terms. And in Canadian and international stocks, on the other hand, increased only about 1% or so in aggregate.
Thanks, Paul. That's a lot of information. Very helpful, though. So it was recently Canada Day, and Canada is 156 years old this year. And on that note, how is the Canadian economy doing now that we have emerged from COVID? Are we remaining competitive on a global basis, and why does that matter?
Wow, those are really big questions to answer, Janet, but I'll do my best. So in a lot of ways, I'd say that Canada's economy is doing pretty well right now. Inflation, which peaked at 8.1% last summer, is down to about 3.4% in May, so that's good. As I just mentioned, economic activity and consumer spending continues to be strong and has been surprisingly resilient in the face of higher interest rates. Consumption growth, for example, in the first quarter was 5.8%, which was higher than expected. Housing activity has also been picking up, which is a good thing since real estate is now by far Canada's biggest economic sector. And the labor market continues to be fairly tight across the country, which is good for those of us who are employed, as wage growth is close to 5%. Now, to your question on competitiveness, though, one big picture problem is that Canada is in the midst of a very concerning trend of declining labor productivity. In fact, Canada's productivity, defined as real GDP per capita growth, which had been growing fairly steadily for decades, has now been negative for 10 out of the last 11 quarters. While some of this is just the reversal of the spike in productivity that we saw at the beginning of the pandemic, that reversal was completed 2 years ago. In fact, our productivity is now well below the trend that was in place pre-COVID. Now, to be clear, Canada is not the only country that's struggling with sluggish labor productivity. The US is also scratching their collective heads over this problem, with some blaming the shift to work from home arrangements that many companies have kept in place post-COVID as one of the leading culprits. However, Canada's productivity growth is lagging the US and most other developed countries. So why is this? Canadian businesses, on average, do not invest enough. Fixed capital investment by businesses, be that in machinery, software, intellectual property, for example, fell significantly in Canada following the 2014 collapse in global oil prices. And unfortunately, it hasn't recovered anywhere near back to trend. Now, as to your question, Janet, is of why does this matter? Well, labor productivity defines our standard of living over time. If our businesses don't increase their capital investments, and if our productivity doesn't break this downward trend, our standard of living in this country will only continue to suffer. 40 years ago, GDP per capita in Canada was almost the same as it was in the US, adjusted for currency. Today, it's about 25% less, and that's terrible. So how do we fix that? Well, that's another really big question that we'll maybe leave for another day. But for investors thinking about how to structure their investment portfolios for the long run, this is one of the reasons why it is so important to have at least some exposure to non-Canadian investments.
Thanks, Paul. So having said that, I know you are bullish on Canadian equities over the coming year. Can you maybe explain why and how investors can position themselves accordingly?
Well, I guess I'll answer that question with the big caveat that a lot of unexpected things can happen in a year that will impact stock prices. But at this moment, yes, I'm feeling fairly sanguine about the Canadian stock market's prospects in the coming 12 months, notwithstanding what I just said about Canada's declining productivity. A lot of my near-term optimism is rooted in the Canadian stock market's relative valuation. Currently, the S&P TSX Composite Index is trading at about 13 times forward earnings, which in absolute terms is a fairly attractive multiple. But compared to the US stock market, which is trading at 19 times earnings, Canada is looking downright cheap. Now, you can argue, and you'd be right to argue, that the Canadian stock market should trade at a lower multiple than the US market, because the US is home to a lot more global growth stocks than Canada is, especially in the technology sector. However, even adjusting for that, the Canadian market's discount relative to the US market is lower than it's been in at least 20 years. And it's not just earnings. The dividend yield of the Canadian market is now double that of the US market. And historically, that's never been the case before. So over the next year, some industries and sectors will do well and others won't. But overall, I'm expecting a total return of about 12% for the S&P TSX Composite Index. A 3 to 4% or so will come from dividends, 5% will come from earnings growth, and the rest will come from a modest expansion of the earnings multiple. So in a year, Janet, we can revisit this and see how close or far away my prediction was. I believe investors should have exposure to the Canadian stock market in their long-term investment portfolios. And I'd recommend investors consider the Capstone Canadian Equity Income Strategy, which is designed to generate a return greater than the composite index over time, but with slightly less risk.
Thanks, Paul. Let's turn our attention now to the housing market for a bit. Obviously, we are in an environment of elevated rates compared to, say, a year or two ago. Can you comment on how that affects our investments, especially our real estate investments and also our mortgage pools?
Yeah, definitely. So broadly, higher interest rates do obviously have meaningful impacts on real estate and mortgage investments, but in different ways. Regarding our mortgage pools, higher rates pressure developers' margins, especially those who borrow at variable rates, which is very popular in the construction and development industry. For new mortgages coming into our pools at these higher rates, we are looking for projects at higher margins and more collateral. For existing mortgages, higher rates are causing interest reserves to be depleted much more quickly than what projects' pro forma financials were anticipating. So developers are needing to access additional capital, and we are needing to extend some of these mortgages as we work through the changing environment. Beyond that, though, higher rates have been impacting the market as a whole pretty significantly, as construction across the country has slowed meaningfully. Projects that had slim profit margin expectations to begin with are now being shelved. When we were in the midst of the aggressive rate hikes, the industry collectively took a bit of a step back and waited for a bit more certainty as to where rates would end up. Now that it appears that we are a lot closer to the end of the rate cycle than the beginning, we're seeing signs that people are adjusting to the new reality and are planning accordingly. Now, for real estate as a whole, the impact of higher rates has been fairly different from type to type. For student housing or residential real estate in geographies where there are no rent control restrictions, as an example, investments are generally doing well. Net operating incomes are rising, so this offsets the negative impact that higher interest rates have on valuations. Industrial real estate, like warehouses, has also continued to perform well. One effect of COVID is that many companies are reshoring their offshore production and distribution, and this, combined with robust consumer demand, has resulted in an increased need for industrial space. Commercial office properties, on the other hand, are really hurting. Or, commercial office, I should say. They have been hit with the double whammy of many employees not coming back into the office because they can work from home, and then debt refinancing at higher rates dramatically impacting the equity value of those investments. In major markets like Los Angeles, San Francisco, New York, as an example, office vacancy rates are at record highs, and we are seeing significant pressure on valuations. Secondary markets, on the other hand, are not as negatively impacted.
Thanks, Paul. That's really insightful. And now we're down to our last question, so thank you for bearing with me. Now, since we last spoke, which was last quarter, in fact, we have now launched our Capstone Treasury Pool. And although it is still early days, can you give some comments on how that's been doing and why someone should consider incorporating this latest fund into their allocation?
Yeah, definitely. So we officially launched the Capstone Treasury Pool at the end of May, so just about 6 weeks ago now. It's about 70 million in size, give or take, currently, but generally it's growing. The Treasury Pool is structured as a Canadian mutual fund trust and is intended to be a very low risk, highly liquid cash substitute. Currently, it is invested in a combination of negotiated high interest bank accounts and GICs, although we do have the ability to invest in other cash-like instruments if we feel that we can generate some extra returns. One benefit of the Treasury Pool to our clients is that it generates a very competitive return in the form of interest income, and it is liquid and immediately accessible. If you need access to your money, the sale of units of the fund settles in one business day. Now, the rate of return that our clients can expect to achieve is dependent on how short-term interest rates move. Yesterday, for example, with the Bank of Canada increasing the overnight rate by another 25 basis points, the expected net rate of return for the Treasury Pool increased from roughly 4.4% to 4.7%. So if interest rates do keep on climbing, the return of the Treasury Pool will also keep climbing. Clients can use the Treasury Pool in two ways. It can be used as a vehicle to park your cash for short periods of time. So if you have, say, $50,000 in your bank account that you're going to use for the purchase of a car in a few months, you can safely park those funds in the Treasury Pool while you wait and make a better return. Or now that interest rates are back to mid-single digit levels for the first time in many years, clients can consider the pool as a long-term investment as part of their overall portfolio strategic asset allocation.
Great. Thank you so much, Paul, for your insight, and really well said as well. I know you're becoming quite the regular when it comes to our quarterly updates, and I think it's been very valuable for our viewers. So thank you again. And to our viewers, we hope that you have enjoyed this quarterly update, and please stay tuned next month for the next edition of Your Wealth Matters. Goodbye for now.
Thanks. Bye now.